I'm delighted to be here today. Great to see so many friends in the room. At Bridgewater, our mission is to really deeply understand the global economy, and we've spent the last 40 years really trying to systematically build out our understanding of how the global economy works. And as we've just heard in the prior session, the decarbonization of the world is the defining challenge of the 21st century and will fundamentally change many, many parts of our global economy. And therefore, for us, with our aspiration to really understand economies, it's imperative that we also understand how carbon transition dynamics will impact macroeconomies, will impact industries. We think a lot about how particular policy choices that are meant to encourage the carbon transition, how that will impact economies and markets. And then we, in addition to that top-down perspective on the carbon transition, we've really invested a lot of efforts over the past 5 years to understand this issue also from a bottoms-up perspective, looking at individual companies or countries, but especially companies, and see how do they fit into this carbon transition movie. Where are companies today, and in particular, trying to come up with a forward-looking view of how individual companies will fare in this carbon transition. And this, we believe, is relevant, A, because it's to understand the potential risk that this might impose on investment portfolios and, of course, the economy. But B, also because to the extent that investors want to not just manage risk, but actually want to proactively deploy capital in a manner that is financing the transition, in other words, being not just considering the financial aspects, but also the sustainability impacts of their portfolio, it's critical to be able to understand at the security level which companies, so to speak, are part of the solution and which companies are part of the problem. So I'm going to introduce you a bit to that research of what we've done, pull you into some of the dilemmas that we have faced in this research, some of the lessons we have learned, and talk a little bit about how we apply that to portfolio construction. As an investor, how can we think about which companies, maybe simply put, are part of the solution, or at least are important in the transition? And we find it helpful to look at 3 types of companies that we've somehow simplistically labeled leaders, enablers, and improvers. Leaders are really 2 types of companies. Basically, they're the ones that they're not the problem. They are on track. They may even either be companies that were born emissions light. I mean, the business models are not very emitting, so great, they're not part of the problem. It may also be the companies who have actually made a transition of their business model and have gone from being unsustainable to being sustainable, or to really reduce their emissions in a great way. So there are clearly some, as I showed before, but not that many. Then you have what we call the enablers, but effectively the companies who are critical for other companies in terms of making the transition. So, of course, various types of anything from green tech to the discussion we just had before about companies that actually, industrial companies that actually create solutions that other industries need to reduce their emissions. Clearly, that's very important also. The last category is one that we are particularly focused on because it's particularly challenging, and that's this notion of improvers or transitioning assets. So, in other words, entities that we know today are not sustainable, but are they on a forward-looking path to become sustainable? It's very tricky. This group of companies is very tricky because, on the one hand, as we saw on the previous slide, you can't just sit back and assume that, look, everyone is going to figure it out. The whole world is going to transition. I'll remain invested in the index. It's going to work out. I'll engage a little bit and it will work out. We know some of these companies, many companies, will actually not be an improver. So first, how do you identify the ones that we believe credibly will be an improver? And then secondly, you have the challenge that, especially if you care a lot about sustainability, you care about how you look to the world, these companies don't look good today. So it requires you to lean in to companies that are unsustainable today. It may even hurt your portfolio metrics, carbon metrics and others. But if you care about real world outcomes, they're the most important ones for the transition. So one of the things that we spend a lot of time thinking about is, well, how would one go about systematically identifying who these companies are, the improvers are, and importantly, try as much as possible to validate the credibility of the improvement plans that these companies put forth. What we try to do is answer two kind of simple questions about a company, and that is to try to assess a company on two dimensions: what they do and how they do it. What they do, basically the nature of the business model of a company and how sustainable that is, and then the actual business practices, how they do it. And to try to look at not just where companies are today, so for example on this graph, in a way, Nirvana is the companies who are in the upper right corner. They are the ones who have the best business practices, and their fundamental business model is also great. Imagine if you had a 100% EV company with the best business practices in the world, most responsibly sourced materials in the world, where everything was as perfect as possible. That would be in the upper right corner. Lower left corner are the most unsustainable companies. So what we're trying to do here is to say, can we identify companies that really are in the lower left quadrant and are trying to make this transition to the higher area? I think that leads to a very important question around how should we think about assessing companies' emission plans? Like, how do we actually know whether a company will be on an improvement path? A couple of the questions that we try to look into is, well, number one, is there even a proven abatement path for this industry and this company? In other words, is there a proven way whereby this particular company can actually reduce their emissions? If there is a proven technical way of doing it, it just hasn't been done yet. That, of course, makes a plan more credible. If it's effectively an unproven technology that we hope will come in 2040, and we will wait until that happens, that makes a plan less credible. Second point we're trying to look at is really how economic is that abatement plan. Some people will refer to this as a green premium. In a way, the lower the green premium is, or in a way, the more financially viable that abatement path is, the more credible we think the path would be. A third thing really has to do with the specificity of the actual emission targets. This, I think, is a very important question, and I think where we really see differentiation. First of all, this, of course, is super hard for the companies themselves to even figure out what their decarbonization plan will be. But the difference between a company that has a vague 2050 net zero commitment and what we see in certain industries where you have more and more specific targets in specific segments by specific dates, just literally the specificity of a target, I think is in of itself a relevant dot to look at in terms of the credibility of an improvement path. Then, of course, there's a question of, hey, all this, is this reflected in the corporate strategy? When you actually hear CEOs talk to investors, is this front and center of what the company is actually doing and talking to the markets about? Is it reflected in the governance of the companies? And I think very importantly, is this reflected in how companies spend their money? Can we look at green CapEx? Can we look at green OpEx? Can we look at the plants being built? Can we look at the supply chains being rejiggered? Like actual things that we may not have the outcome yet, but we can look at some of the steps taken. And does this align up? And another thing to look at is financial strategy. Is literally the way these companies finance themselves and what they use the proceeds for, is that aligned? All these things, we think, it can help paint a picture of systematically of whether we believe companies can be on a good forward-looking path. I wanted to end just on a couple of reflections around this research area. I think what's clear in our minds is that this is one of the most important, but also one of the most challenging areas of research when it comes to sustainable investing. And one of the first three reflections we've had on this one. The number one is the importance of setting the right goals. We know this is true in life. If you set the wrong goal and you get that, well, that's not good. And in this area, it's so important to make sure that what we measure is the right thing. And when we think about, especially as investors, sustainable investing with ambitions in sustainable investing, too much focus on your own portfolio and not enough focus on the real world in terms of your goal setting is very dangerous. And in particular, I think one of the key pitfalls is the idea of saying, I basically either being almost too ambitious on metrics. Like in my portfolio, I want to have a perfect emissions metric by next year. I want it to be reduced by 25% year on year. We just looked at the world. The world does not look like that. Corporates do not look like that. The only way of getting very short-term great goals is basically get rid of all the intensive industries. That may help your portfolio metrics. It doesn't help the world that much. On the other hand, doing the opposite of just saying, well, I'm just going to, the whole corporate world is going to transition. I'll just stay invested in the index, and then I'll improve in line with the world. As we've just shown also, that's not also an option. So how do you get this balance of saying, no, we actually do need the world to transition. Not all companies will transition. We have to lean into the ones that do. We have to be willing to take tracking error. We have to be willing to understand that in the short term, that may mean that some metrics of the portfolio will look bad, but it's in the goal of getting real world emission reductions and of course also long-term portfolio reductions. That whole notion of setting the goal right, at least in our mind, is one of the most important things. Two, for us, in all of our research, we believe in the importance of really fundamental and systematic research and assessments. And I think in the world of sustainability, and in particular when it comes to forward-looking assessments, that is just so important because especially in a world where there's imperfect data, we just don't have the full answer. And so unless you really have a rigorous and systematic approach, we think it becomes very difficult. The final point that I think all of us, certainly we have had to get comfortable with, is the inherent imprecision when you make forward-looking assessments. The truth is who really knows how these transitions will occur for the world and for the individual companies. And you may in fact have companies who are in fact trying to do all they can to transition and they may not reach it. And on the other hand, you may have companies, and you have companies that are in industries where they just legitimately say, we just don't know how we're going to transition. And so there is a significant element of imprecision. One of the key questions that we ask ourselves is really how do you deal with ambiguity? And at what point do you have enough information to start to make directional calls? And do you have no information? Do you have directionally correct information? And our view on this, again, on the third point, is that we feel we have enough to start directing capital in this manner, but we're trying to be very humble in terms of it. We're not we can't persuade ourselves that we are super precise about exactly where these transitions will go, but enough to make the relative assessments of who's on a good track and who's not.